Ever felt that knot of anxiety in your stomach wondering if you'll get approved for that car loan, that mortgage, or even just a new credit card? You're not alone. For millions, the answer often hinges on a single, three-digit number, your credit score. But how exactly does this seemingly arbitrary number wield such power, especially when you're looking at a lender like Truist? Think of your credit score as a financial report card. It's a snapshot of your creditworthiness, a numerical representation of how reliably you've managed debt in the past. Lenders like Truist use this score to quickly assess the risk involved in lending you money. A higher score generally signals a lower risk, making you a more attractive borrower. Conversely, a lower score suggests a higher risk, which can make loan approval trickier and potentially more expensive. Now, let's zoom in on Truist. Like most financial institutions, Truist uses a tiered system when evaluating loan applications. This means they have different credit score ranges, and where you fall within those ranges significantly impacts your chances of approval and the terms you'll receive. While Truist doesn't publicly disclose the exact cutoffs for each loan product, we can talk about the general credit score ranges and what they typically mean in the lending world. The most common credit scoring model is FICO, which ranges from 300 to 850. Generally speaking, exceptional, 800 to 850. If your score falls in this range, you're in excellent shape. Truist will likely view you as a very low-risk borrower. This often translates to the best interest rates and loan terms available. You'll likely have a smoother approval process for various types of loans, from mortgages to personal loans and credit cards. Very good. 740 to 799. A score in this range is also considered very strong. You'll likely qualify for most loans with favorable terms, although perhaps not quite as optimal as someone in the exceptional range. Truist will see you as a reliable borrower. Good. 670 to 739. This is considered the average range. While you'll likely be approved for many loans, you might not get the absolute best interest rates. Truist will likely see you as an acceptable risk, but they might have slightly stricter terms compared to borrowers with higher scores. Fair. 580 to 669. With a score in this range, loan approval becomes more challenging. Truist might still approve you, but you'll likely face higher interest rates and less favorable terms. You might also have a lower loan amount offered. This range signals to lenders that you have a history of some credit issues. Poor. Below 580. This range indicates a significant credit risk. Getting approved for loans from Truist or any other reputable lender will be very difficult. If you are approved, expect very high interest rates and potentially stringent conditions. Lenders see this as a high probability of default. It's crucial to understand that your credit score isn't the only factor Truist considers. They also look at other aspects of your financial profile, such as credit history. This goes beyond just the score. Truist will examine the length of your credit history, the types of credit accounts you have, and your payment history. A longer history of responsible credit use is generally viewed favorably. Debt-to-income ratio, DTI. This is the percentage of your gross monthly income that goes towards debt payments. Truist will assess if you have too much existing debt relative to your income, as this could impact your ability to repay a new loan. Income and employment stability. Truist wants to ensure you have a stable and sufficient income to handle your loan obligations. They will likely ask for proof of income and employment history. Down payment. For certain loans like mortgages and auto loans, a larger down payment can reduce the lender's risk, potentially increasing your chances of approval and securing better terms, even if your credit score isn't perfect. The specific loan product. The requirements for a mortgage, for example, are generally more stringent than those for a small personal loan or a secured credit card. So, while your credit score is a significant piece of the puzzle, Truist takes a holistic view of your financial situation. Now, what if your credit score isn't where you'd like it to be? The good news is that it's not a permanent condition. You can take steps to improve it over time. Here are a few key strategies. Pay your bills on time. every time. This is the most crucial factor. Payment history has the biggest impact on your credit score. Set up automatic payments or reminders to ensure you never miss a due date. Reduce your credit utilization. This is the amount of credit you're using compared to your total available credit. Aim to keep your credit utilization below 30% and ideally even lower. For example, if you have a credit card with a $10,000 limit, try to keep your balance below $3,000. Don't open too many new credit accounts at once. While having a mix of credit can be good, opening several new accounts in a short period can lower your average account age and potentially raise red flags for lenders. Avoid closing old and used credit accounts. As long as they don't have annual fees, these accounts can help increase your available credit and improve your credit utilization ratio. The age of your credit history also plays a role in your score. Regularly check your credit report for errors. Mistakes can happen. Obtain free copies of your credit report from all 3 major credit bureaus, Equifax, Experian, and TransUnion, at least once a year and dispute any inaccuracies you find. Consider secured credit cards or credit builder loans. If you have a poor or limited credit history, these can be tools to help you build positive credit. Secured credit cards require a security deposit, while credit builder loans are small loans where the funds are held in an account until the loan is repaid. Understanding how your credit score affects loan approval with Truist, and with any lender for that matter, is essential for achieving your financial goals. By knowing where you stand and taking proactive steps to manage and improve your credit, you can significantly increase your chances of getting approved for the loans you need at favorable terms. Remember, building good credit takes time and consistent effort, but the rewards in terms of financial opportunities are well worth it. With that said, thanks for watching, and until next time.